Good afternoon, ladies and gentlemen, and welcome to Money Talks Media, our bi-weekly show dedicated to growing your money in and around the GTA. We've lined up a serious roster of speakers, including investment professionals, tax accountants, CRA experts, hedge fund managers, portfolio managers, you name it, we've got it on Money Talks Media. Money Talks Media is proudly based on the public speaking series Toronto Talks, now in its 9th year as a public speaking venue. And we encourage you to come out and attend our events. Our next event is Tuesday, March 29th, and it featured Jerry Cherbatsky, and he's going to be talking about the art of making rain. So if you're self-employed and you need business and you need clients to walk through the doors, this is a must-see. You can check that out at torontotalks.org. And of course, if you're listening to this show, you can feel free to attend. All we ask is you drop a loonie or toonie in the bin, which goes towards a camp for children with cancer. So again, that's torontotalks.org, and come out and hear about the art of making rain. Money Talks Media is proudly sponsored by Northwood Mortgage Life and Partners in Planning Financial Services. Let us show you how to take years off the life of your mortgage, and let us show you how to create a tax-efficient environment for yourself. And you can check us out at Northwood Mortgage Life and request our newsletter. As well, if you missed one of our prior sessions, you can check it out at moneytalksmedia.com. That's moneytalksmedia.com, and we've got about 70 shows there, all for your viewing pleasure, and there's lots of great intellectual content. On that note, here's our caveat. You're going to hear lots of free advice, and that's what it is. It's free. Always speak with your financial advisor first before acting on anything, as we waive ourselves of any liability, and you can read our little fine print on that. Now, let's get on with the show. Today, Money Talks Media talks U.S. tax talk with our good friend Laurie Zahn, chartered accountant, chartered CPA, Illinois. Welcome aboard, Laurie.
Hello, John, and thank you for having me.
Our pleasure. It's just great to have you on board. I've known you for a number of years, and I've always had a lot of respect for the work that you're doing, and I know you work specifically with people who have U.S. interests.
Yes. I run a boutique practice where I only deal with people who have something in the U.S., whether they're a U.S. citizen living in Canada or whether they're a Canadian investing in the United States.
Excellent. Now, today, and I know we've talked a number of times, it seems to me that there's a lot of discussion about people looking for places in the United States, especially with their perceived devaluation of their real estate market. I know people are picking up bargains. And I know there's some ramifications to that. Maybe you could talk about some of those things that are going on there.
Definitely. There's not a day that goes by that somebody doesn't call me and tell me that they were looking at buying property, especially in Florida or Arizona, or that they've already purchased it.
Okay.
So there's a couple of perceptions. The one perception people have is it's the best time to buy now. One of the reasons is the Canadian dollar is on par.
Right.
And the market, in their mind, has crashed.
And how do you feel about that, by the way, just as an aside?
Honestly,
Yeah.
I think people forget when the ratio of the dollar was to $1.50.
Mm-hmm.
And I honestly feel that there's still room for market values to decrease in the United States.
And isn't that interesting? So you don't think it's bottomed out?
I don't think it's bottomed out at all.
Interesting. Okay, because I can just think of people I know who've bought condos, and I hear you, where they bought something in Miami for the purpose of a discussion, and the mortgage was higher than the value of the property they purchased. Their perception is they stole it, and that's interesting because you're saying it could go down further, and that I believe it.
I believe it can still go down further. I don't think it's a bad idea for them to buy, depending on the reason they're buying.
Mm-hmm.
It used to be that for a lot of the properties, they were untouchable,
Right.
unreasonable. So there are a lot of people who've watched the values over the years.
Okay.
So now's the time that they feel they can buy.
Okay. And that's the discussion. Okay.
Right. So if they're buying the property because they see it as somewhere that they want to live in a few years, I think is a great idea.
Okay.
If they're buying it just for the prospect that they think that in 5 years they're going to flip it for a capital gain,
That's
maybe not.
That's not a good enough reason. But maybe it's a retirement plan. Maybe in the next 5 or 10 years they are going to retire to this place. So what are some of the things they need to know about when they're doing this? And let's talk maybe about someone who already owns a property and someone who's looking into it.
Okay. So for starters, It depends on what they're buying it for.
Okay.
So most people are buying the properties because they think that they can put a tenant in there and they can rent the property out.
Yes.
In a lot of those cases, they believe that they're going to break even and the property will hold itself.
Okay.
Okay. What they forget is that that is U.S. real property and it is sitting in the United States of America. So there's tax consequences that they have to deal with.
Okay.
So if you're renting a property in Canada, you would expect to have a small rental statement, and you would put that on your tax return in Canada when you file.
Right.
So if you're renting a property in the United States out to a tenant, it's your property, you're still expected to report that rental income to the IRS.
And what are people doing? They're probably not.
Yes and no.
Okay.
Okay, most of the clients I deal with are obviously filing a U.S. tax return.
Okay.
Okay, it's a U.S. tax return just on their rental income.
On the rental income,
Yeah,
okay.
so it's a non-resident return. It doesn't encompass everything they have. It just encompasses their U.S. property.
Okay.
Okay. And there's other reasons, because a lot of people are purchasing properties that are managed by a management company.
Right.
Okay,
Right.
So they have no choice.
Okay, and that's
Okay.
probably the better scenario, right?
In a lot of cases, it's a better scenario because they have somebody looking after their
Right.
property for them.
Okay.
Because we don't want to be landlords, especially when we're located here
Right.
and the tenant and your property is located in the United States.
Fair enough. Fair enough.
But they forget that there's a lot of things that they're going to have to start to deal with.
Okay.
So if you're filing a U.S. tax return, something very simple is an individual taxpayer identification number.
Okay.
Okay, so that is a number that is given to an individual who is not eligible to get a Social Security number.
Okay.
And they need to apply for that number. And that becomes a process in and of itself, because they can't just send an application away and get the number. They have to go through certain processes. One of the processes they have to do is get the documentation notarized by a U.S. notary.
Yes.
Or what they can do is they can actually come to me because I'm an acceptance agent for the IRS.
Oh.
Yeah.
Interesting.
Yes.
Now, how does that come from being a CPA?
No.
Or okay.
In order to be an acceptance agent for the IRS, actually, I had to go through a process.
Okay.
And I had to apply to the IRS, and the Internal Revenue Commissioner and I have a legal document that
Yes.
allows me to just review documentation for the purposes of processing these individual taxpayer identification numbers.
Interesting.
Yes, and then
Okay.
every so often they make the process even more difficult, or they ask me to do things. Like a couple of years ago, I had to go get fingerprinted.
Oh, really?
Yes.
I mean, you perceive that as a criminal getting fingerprinted?
You have
not
to
as a-
remember, sorry.
Yeah, go ahead. No, I'm
sorry,
just curious.
9/11,
Yes.
right?
I remember it well. Go on.
Okay, so the individual taxpayer identification number is a tax number per se.
Right.
So it allows people to open bank accounts in the United States.
Okay.
Okay, so the IRS is very careful as to who should get these numbers,
Okay.
because there's other reasons people would get the numbers to open bank accounts, money laundering, arms, things that we wouldn't
Sure.
think about, but they have to protect everybody.
Makes a lot of sense. Okay, carry on.
So once they get this number, then they're expected to do up a small rental statement and file a U.S. tax return. It's even more important because the tax rules are different in the United States. So in Canada, I don't know if people are familiar with the fact that you get a property and the property is worth $100,000, and they choose whether or not they're depreciating the property or they're not depreciating the
Okay.
property. In the United States, the rules are a little bit different, so they're forced to depreciate the property.
Okay, right. No
Okay.
option.
No option.
Okay.
And what happens is the depreciation that they really didn't need goes into their loss pool.
Okay.
Okay, so the rules are more complicated than people give them credit for.
So this is someone who's considering buying or already owns a property. Some of the things they need to work
If they're renting it.
if they're renting
If
it.
they're renting it.
What is that sort of a complicating factor if they rent it, or is it easier if they just own it and wait for some sort of appreciation? What are your thoughts on that?
Well, if they're buying it for a pure vacation property, then they can buy it, and there's no issues until they sell the property.
Now, do you want to talk about some of the issues when they sell it? Because that's in that. Okay, Karen. Sorry.
Yeah, no problem.
Okay.
When they sell the property, the IRS is going to make sure that they report the gain or loss on the disposition of the property.
And that's based on U.S. taxes. That has nothing to do with
Correct.
that. has
Nothing to do with Canada.
Okay.
So what the IRS does is they withhold 10% of the proceeds on the sale. So the lawyers who are
Right.
closing the deal, you could have bought the property for $100,000 and now you're selling it for $100,000. But when you go to sell it, your lawyer's basically going to tell you that he's going to take $10,000, 10% of the 100, and remit it to the IRS.
Now, how is that gain It's only included on your U.S. tax return. Like, let's say you bought a property for $100,000, you sold it for $200,000 5 years later. You were one of those people who it didn't bottom out on. You have a $100,000 gain. I know how that would be dealt with in Canada on a secondary property. How would it be dealt with in the States?
In the United States, you're going to pay your tax between the proceeds less the cost base.
Okay.
Right? So same deal.
Same
proceeds
idea.
minus cost base. You pay your fair share of tax, whether it's just federally or whether there's a federal and a state. There's no Florida individual tax. Then you take the same disposition, the same transaction, and you report it on your Canadian return.
Okay.
Okay. And on your Canadian return, you're eligible for a foreign tax credit for what you pay to the United States.
So how does it work out? Does it work out effectively you're paying the same taxes in Canada, or is it a little bit more?
There's two issues.
Yeah.
Effectively, if it's a Florida property where there's no state income tax for individuals, you're paying at the top rate 15%.
Okay.
And in Canada, capital gains are included at a rate of 50%.
50%, right.
So basically, you're paying about 23%.
Okay.
So you're going to kick Canada in another 8% on that disposition.
Right. So it is a little bit more odious than just buying a Canadian property. There's another ramification here.
The ramification is always that you have a second set of tax filings to the United States.
Okay, all right. Anything else? So what are some of the other issues that people need to do when they're looking at purchasing or selling these properties?
Okay. Well, if they're looking at purchasing the property as a rental property, they have to be aware of the fact that they're going to have tax filings. So, for example, I had a husband and wife who purchased a property for $60,000, and they put it in the husband's name and the wife's name.
Okay.
Okay, so now they have two people who have to report 50% of their rental income, so they have two tax returns to file.
That's not the best way to do it. The way you're saying. Okay, how should they have done it?
At $60,000, they should have just had one of them own it.
Okay. When does it make sense for both of them to own it?
You would have to look at all of their worldwide assets as well, but probably when it's over $300,000, $500,000.
Okay.
Yeah.
All right. What other things are involved in this? I know there's a number of mitigating factors.
Well, I think, again, you have to look at whether or not you're buying it for personal use or whether or not you're looking to rent it.
Okay.
Okay, and then you have to be realistic as to whether or not you're actually going to get a tenant that is going to come in for a long enough time that you're going to be able to recover your costs.
Interesting. What about some estate planning issues? What if you die? What happens with the properties?
They've just increased the estate tax exemptions very high. So for the most part, unless the property is a couple $1 million, it's not going to be affected.
Okay.
Okay. You still, from an estate tax perspective, you have to file your U.S. tax return and your estate tax return. But right now, nobody's too concerned about it. But that might change.
Okay. All right. Anything else? Any other tips things you think are relevant with respect to purchasing property in the United States?
Well, I think when you purchase any property, you have to make sure that the investment stands on its own to some degree.
Interesting
and that it makes
point.
sense.
Right. A lot of people just get caught up in the price and okay, fair enough.
And then your financing. Like, I would never tell somebody to buy a property if it's going to stretch them from a financial perspective.
Right.
Right. And then most of the banks down there are not going to give Canadians financing.
Now, why is that? Just is that just a
we don't really have
thing?
A credit
you don't
history
have credit
with
in the
them.
States. Okay.
The banks that are holding the properties that have been foreclosed just want to see cash.
So
for
they're
those properties.
saying, okay, so they're saying out of country, get your own financing.
For the most part.
And how are people financing them generally, do you find?
Generally, they're going to their own mortgages. So if they've paid off their principal residence, they're going to try to basically get a credit line and allocate that credit line in such a way so they can, track their expense, their interest expense, so they can deduct it.
That's an interesting thing in terms of deducting the interest payments. I know it's a secondary property, so there is interest deductibility. Is that correct?
Correct.
Okay.
Well, the issue is that you're allowed to deduct interest on a property that's going to produce income.
Right.
In the United States, they're actually allowed to deduct interest on their mortgages, so it's not a big deal there. But from our perspective, sitting in Canada, we have to be careful that there's a real trace for the interest deductibility so that CRA does not come in and question deductibility.
Interesting. Okay, so anything else, any other tips you would provide someone with who is looking at these purchases?
I would tell them to really make sure they're comfortable with the area of where they're purchasing and understand what they're purchasing.
Yeah.
It depends if it's new or if it's a resale.
Yes.
I had a friend who wanted a penthouse suite of some sort, but the property is only 40% occupied, which means the condo maintenance fees would only be split amongst the people who were actually occupying the building.
Interesting.
So there's hidden costs.
I've heard of that, and I have some friends of mine who have purchased properties in Florida, and they say after 10 years there's a levy on the building for refacement, and there's some interesting things that come up that you're not aware of.
Yes, definitely, because you have to pay your condo fees, and they can be increased based on who's in the property.
Right.
Some people tell me that they try not to allow certain people purchasing in their property because they may not want to upgrade the property.
Fair enough.
Right.
Okay, we're going to take a quick break. We've been talking to Laurie Zahn about purchasing property in the United States and some of the tax ramifications on both the U.S. and Canadian tax returns. We'll be back. This is Money Talks Media.